All right, so as we get into part two, I want to kind of back up a little bit for this Road Warriors example because I think I skipped over some of it. So I want to talk about the Road Warriors predetermined rate. So what happens when we're looking at this predetermined overhead rate is we're figuring out how to apply overhead. And in this case, we're linking it to the activity base. The activity base they're going to link it to is direct labor. So when we're doing that, you have to know what is the total estimated direct labor costs. So in this example, it's $125,000. So that's our estimated activity base. That's our bottom number. Their estimated total overhead costs to be $200,000. So if we have that $200,000 divided by $125,000, we get 160% of direct labor cost as our predetermined overhead rate. So then if we look at the next slide, if we take that direct labor cost, which is $4,200, that's what we calculated, and we take the 160% overhead rate that we calculated times, so 1.6 or 160% times the direct labor costs for each of the jobs, and that's going to give you the applied overhead. So that's what we see here. So then overhead will be allocated to each individual job based on the amount. So this is going to show the entry that's allocated where it goes into work in process inventory and it's taken out of factory overhead. So that's the example that we have for Road Warriors. So this is the estimate and it will be adjusted for actual. All right, once we do the estimate, it has to be adjusted where we know the actual at the end of the period, and that's what we're going to look at next. So we have the factory overhead, which is going to include all the factory costs other than direct materials and direct labor. We have two sources, which are indirect materials and indirect labor. The costs are recorded from materials requisition forms for indirect materials and from salary contracts or time tickets for indirect labor. We have other sources of overhead that can be vouchers authorizing payment for factory items like supplies or utilities. And we might also have adjusting journal entries that we have to do for costs like depreciation of factory assets. So when we're looking at this, our factory overhead usually contains a lot of different costs. Those costs are recorded with debits to factory overhead in the general ledger account and with credits to those various accounts. So the next slide, we're going to look at how do we record journal entries for actual overhead costs. And then what we're going to see is that we've done our estimate and then we have actual, and that will tell us whether we've over applied or under applied our overhead. So if we look at our next one, we can see that we're going to record the indirect materials used. So it's during March, Road Warriors incurred $550 of actual indirect material costs based on the materials requisitions that they had. So the use of the indirect materials yields the entry that we see here, where we're debiting factory overhead and we're taking out of raw materials inventory. The entries can be posted to our general ledger accounts, and it's going to be posted to the indirect materials in our subsidiary factory overhead ledger. So unlike recording the direct materials, actual indirect materials costs incurred are not immediately recorded in the work in process and are not posted to job call sheets. When we look at indirect labor, Road Warriors incurred $1,100 of actual indirect labor costs. So these costs might be supported by either time tickets for maintenance workers or salary contracts for our production supervisors. And the indirect labor is going to show the entry where we debit factory overhead and we're going to be crediting factory wages payable. So again, we're posting it to the general ledger for factory overhead and factory wages payable. And unlike the recording of direct labor, indirect labor costs are not recorded immediately in work in process and are not posted to the job call sheets. Next, let's look at the other overhead costs. So during March, Road Warriors incurred $5,270 of actual other overhead costs, and those costs could be items like factory building rent, It could be utilities they had to pay for. We had an adjustment for prepaid insurance, and then we had depreciation. So we're debiting factory overhead for the total and crediting each of the payables that we have, or the adjusting entries we would do, like accumulated depreciation and then prepaid insurance. Looking at the summary, this is just going to show us that the direct materials used, direct labor used, and factory overhead applied flow throughout the work in process inventory and the finished goods balance sheet accounts. The cost of goods manufactured is computed and shown on the schedule of cost of goods manufactured. When goods are sold, their costs are going to be transferred from finished goods inventory to the income statement as cost of goods sold. Remember, period costs do not impact our inventory accounts, so they're not going to impact cost of goods sold, and they're not reported on the schedule of cost of goods manufactured. They're reported on the income statement as operating expenses instead. When we look at another summary here, we can see that the upper part of this shows the flow of Road Warrior's product cost through general ledger accounts. So we see the arrows that are numbered to show the flow of costs for March. So each numbered cost flow shows our journal entries that were made during the month. The lower part shows the summarized job, in whether it's in process, where we see the 1970 and the 1810, that's our work in process inventory. And then we see costs assigned to job B17 equal 3360 in that finished goods inventory, because that was finished. The balances that are in work in process and finished goods are reported at the end of the period on the balance sheet. And the costs that are assigned to job B15 and 16 equal the balance in the cost of goods sold. That amount is reported on the income statement for the period. We can see that those in the delivered goods. Going into the next summary of cost flows, we can see the journal entries that are made in March. Each entry is numbered to link with a slides if we look at the previous one. So if we go back, we can see that number 1 links back with number 1 here, and 2 through 10 do the same thing. It also shows that our journal entry record the sales is recorded in number 10. So we see that sales on account, where we debited accounts receivable and credited sales, just like we would have done in our chapter 5 when we did that a long time ago. All right, looking at our schedule of cost of goods manufactured, we end Road Warriors example with a schedule of goods, cost of goods manufactured. And the schedule's kind of like the one we've seen in the previous chapter, with one key difference. We see total manufacturing costs, and it includes overhead applied rather than actual overhead costs. So in this example, actual overhead costs were $6,920, while applied overhead was $6,720. So we'll look at how to account for the difference in the next slide. So here we can see the adjustment that we're going to do for applied versus actual factory overhead. So when we're applying it, we're putting it as a credit to factory overhead. When we have the actual amounts, we're debiting factory overhead. So what we can see here is if the actual is greater than the applied, then we're going to have a debit balance, and that means that we've underapplied our factory overhead. And we have to do a journal entry by debiting cost of goods sold and crediting factory overhead. If the actual is less than applied, then we're going to have a credit in that factory overhead balance. I mean that means we've over applied it, and we have to do the entry as a debit to factory overhead and a credit to cost of goods sold. So that's how we're going to rectify those differences. All right, so let's look at how do we look at those under applied or over applied overhead situations. So to show you an example, we're going to assume that Road Warriors apply $200,000 of overhead to jobs during the year. This equals the amount of overhead that management estimated in advance for the year, right? So we had $200,000 that was applied. we're going to also assume that they incurred a total of $200,480 as actual. So that means that the factory overhead account would have a debit balance. So that debit balance reflects manufacturing costs not assigned to jobs. This means that the balances in work in process, finished goods, and cost of goods sold do not include all production costs that are incurred. So we have a required journal entry. It's going to depend on whether the difference is under or over applied is material. So when the under applied overhead amount is immaterial, it's closed to cost of goods sold account with the following adjusting entry. So we're going to debit cost of goods sold. We're going to credit factory overhead for the amount of the difference. And this adjusts for the under applied overhead costs. When we're looking at servicing, job order costs for service companies, there's a difference. They're not going to have raw materials or finished goods inventory. They're going to have supplies instead. Those supplies might be considered overhead. The other thing to look at is the direct labor is going to be used to apply overhead. Typically, they're using a different account titles. They're going to be looking at services and process inventory or services overhead instead of manufacturing. All right, so the last thing I'm going to look at is just pricing for services. Again, service providers are also going to be able to use job order costing. They're going to have a cost for each individual job, and they're going to track it separately, just like we did for manufacturing. Total costs include their labor and their overhead. So we can see here that they had the number of hours times the amount per hour for direct labor for the designers, and then also for the staff, and that gives them their total direct labor. For overhead, they had overhead that was designer related, and it had an hourly rate. Staff related also has an hourly rate, and that gives them their total overhead. And they can estimate that job cost in that way. So that's where we're going to end for chapter 19. Again, we have some practice. Make sure you take a look at them and let us know if you have any questions for it. Thank you.